So thanks everyone for being here today. I know it is noon on a Friday. You've got plenty of things that you could be doing, and I want to make sure that I respect your time. So I'm going to go ahead and jump right in. I'm going to start by sharing my screen, and I hope, 4 years after the pandemic started that I can actually get this done and not have problems. So here we go. Today, I am going to be talking about strategies for lowering your taxes in retirement. And I know this is one of those topics that it's kind of boring to most people. Most people say taxes, I'm going to go ahead and take a nap now. I'm done. This is a lot. But talking about taxes is one of my favorite things to do because I've found that when it comes to financial planning, taxes are incredibly overlooked. Investing comes first. It's one of the most common things that people talk about, but you can't have financial planning, you can't have retirement planning if you're not talking about taxes too. And in reality, your investing should also influence your taxes and vice versa. It all goes together. So let's go ahead and jump in on that. Going to start out, there are a couple of principles that really drive tax planning in retirement. Uh, the first is that retirees need income. I think it's pretty straightforward. If you're a retiree, you need money to live on. It might be taxed, it might not be, it might be Social Security, but at the end of the day, you need income coming in. Next, taxes are a fact of life. Going back to Benjamin Franklin, the only certain things in life are death and taxes. Third, not all income is taxed the same. And, like I mentioned, you have ordinary income, you have capital gains that are taxed at a preferential rate, and you have some income that's not taxed at all, like if you're taking a distribution from a Roth. The fourth is that proactive tax planning isn't happening. I talked about this on LinkedIn a couple weeks ago, and it's something I've really noticed over the last 2 to 3 years. And there's a disconnect between CPAs, clients, and financial advisors. Clients always assume that CPAs are doing their tax planning. And in some cases, they are, and they're doing a great job of it. But the problem that I see is many CPAs are overwhelmed because they are working, 100-hour weeks during tax season to get through the 300 tax returns they have to do. And they're being reactive, not proactive. Tax planning is a very proactive thing. You have to be looking for the next year because by the time you're doing your taxes for last year, it's generally too late to do much of anything. The other side of that is financial planners. Financial planners, financial advisors are in a great place to be doing this work, but often they don't. And it's for two reasons that I usually see. The first is their firms just don't allow it. Their firms see that it's a liability, that they're giving advice that they're not comfortable with, and they just say, no, you can't do that. Just don't even do it. When I was at Merrill Lynch, I remember I recommended the client make a backdoor Roth contribution because their income was too high to make a regular Roth contribution. Pretty straightforward, not a big deal. But Merrill said, no, you can't recommend that. That's tax planning. And when they have, thousands of advisors, I understand they have different rules they need to go by. And then the other part of that is a lot of advisors don't have the knowledge to be able to give good advice there. Taxes, it's a whole separate field of knowledge from just, picking stocks, picking bonds, building a portfolio. And it takes time to learn that, and they just haven't done that. And then the last part is just the value of tax planning. I'll show you here in just a second an example, but proper tax planning can make a 6 or 7-figure difference in the size of your portfolio. It is no joke. So let's look at that. So here's a baseline. I just ran a quick report to show what this looks like. And this is for John and Jane Doe. They're not real clients. They're not real people. But this is based on retiring at 60. They have $2 million in a taxable account and $2 million in their IRA. And you can see they're taking money out from their regular account to fund their expenses all the way until they hit 74. Then they have their RMDs. And at that point, their income goes up substantially. And that income, since it's going up substantially, it is pushing them into a much higher tax bracket. And let's look at the difference here. So I'm going to look at this circle, the pie chart on the far right. Based on their current baseline, that $4 million they have, by the time they pass away at age 90, that ends up being $34.6 million. That's huge. That's great. But out of that, a quarter of it is still in an IRA. So their kids, their grandkids, their beneficiaries, whoever that is, it's still going to have to pay taxes on that. But if you look over on the far left at the line chart, line graph, this is with Roth conversions and nothing else. And I'll explain more in a minute what Roth conversions are. But essentially, pushing some of those distributions forward, locking in a lower tax rate, and then letting that money grow tax-free actually gives them $7.2 million more over the course of their life. I mean, we're talking 20% here. That's a pretty big difference. And even more substantial is if you look at the middle pie chart, you'll see the portion that's in green, that's tax-free. So they go from a quarter of their money being taxed to down to around 10% of it being, 7 to 10% of it being taxed, but the majority of that being tax-free for their beneficiaries. We're talking a really big deal when, the final value is almost $42 million. That's over the course of 30 years, that's a huge improvement. So as we're going through the strategies, I want to kind of set a baseline. And there are 3 parts that I'm going to be using to get the most from these tax strategies. The first is you want to pay your taxes when your rate is the lowest. Second is pretty similar, but not exactly. And that's just that you want to fill up your lower tax brackets. And the third is that you want to pick the right deduction, whether that's itemizing or standard. And we'll get more into that in a second. So when I say pay taxes when your rates are the lowest, going back to John and Jane Doe, this is their income tax bracket from that first graph, their baseline. And you can see as they get older, they get progressively in higher and higher tax brackets. So they're paying almost 40 cents on the dollar in taxes. You want to make sure that if you can push some of that in and keep more of it in the 20% bracket, that's what you're going to do. So that's what it's all about. Pay taxes when your rates are at the lowest. And then this is a really common misconception that I kind of want to clear up. Taxes are progressive. What that means is the more you make, the more you pay. But what I find is that most people think the more you make, your entire, the rate you pay on every dollar goes up. And that's not the case. So the way it works is it's like buckets. If you look at the 10% bucket on the left, every dollar from 0 to 19,050 is going to be taxed at that 10% rate. And then for the second bracket, from 19,000 to 77,000, it's going to be taxed at 12%. It doesn't matter if you end up in the 35 or 37% bracket overall for your what's called your marginal rate. Your marginal rate is just your highest tax bracket that you're in. That 10% bucket is going to be taxed the exact same. So as you fill up one, you move over to the next and start filling that up. It's a good way of looking at it. Let me go ahead and point out as well. So you'll see the bottom 2018 numbers. I didn't update all the numbers as I was going through this. So some of them are from 2018, some are from 2023, some are from 2024. Really, the specific numbers don't matter for our points right now. They are just here so we can have a baseline just to get an idea of what the numbers look like, because they're going to change year to year. But this gives us some talking points to go off of. And then third, you want to choose the right deduction. So when I say that, there was a big change in 2017 with the Tax Cut and Jobs Act. Prior to that, you had a deduction, then you had some credits, and there was a lot of different ways to approach that. Now, the standard deduction has gone up substantially, and I'm sure you all have seen that over the last few years. If you're over 65 or married filing jointly, your tax deduction, your standard deduction is $30,700. If you're under 65 and still married, it's still $27,700. And why this is important, and we'll talk more about it as well, I've found that most people can't itemize their deductions. It's hard to get over that hurdle unless you're making some rather large gifts. Because once you're retired, most people have paid off their mortgage, and so their mortgage interest has gone down to 0, or they paid off most of their mortgage, and so even then, the percentage going to principal versus the percentage going to interest has still gone down substantially. And then you have state and local taxes, but those are capped at $10,000. And so to be able to get above that 30,000, it's a really high bar. You have to be giving a substantial amount. And the problem there is most people aren't. And not that you should be or shouldn't be, but if you're giving, so for, round numbers, standard deduction is 30,000, you have 10,000 state and local taxes, and you give $10,000 a year. Most people assume that, oh yeah, I can itemize that, I can deduct that from my taxes. But the problem is you can't. Unless you're itemizing, it doesn't matter how much you give, unless you go above that amount where it makes sense to itemize. So we're going to talk about some ways that you can maximize by itemizing most years, and then itemizing 1 year and then taking the standard deduction for a couple of other years. So we'll get into that here in a minute. So also, for just setting the baseline, there are 3 types of taxes that you need to know about, 3 methods of taxing income. First is ordinary income. That just means that you're going to be paying the ordinary income tax rate. It goes from 10% to 37%. The next is capital gains, long-term capital gains specifically. Those are taxed, like I mentioned, at a preferential rate. If you are in the zero, or if you make less than $78,750, you actually pay no capital gains taxes. And I'm going to show you how that you can maximize that here in just a minute. Going from there, you'll see 15%, 18.8%, and 23.8% capital gains rates. And just know that if you have short-term capital gains, those are taxed as ordinary income, or those are taxed at ordinary income rates. So if you hold a stock for less than a year, you sell it, you're going to be paying ordinary income tax rates on that. If you're looking at this chart and thinking capital gains actually top out at 20%, why does it say 23.8? That is the net income tax, investment income tax, 3.8% surcharge on top of that. So it actually goes 0, 12, 15, and 20, but for our purposes, 23.8 is basically where it maxes. And then finally, non-taxable. Roth IRA withdrawals, as long as you meet the criteria, had it open for 5 years, and then you're over 59.5, those are tax-free. And then a return of basis. If you buy a stock for $100, you sell it in a year for 110, you're only going to be taxed on that $10 worth of growth. You won't be taxed on the $100 that's your basis in the stock. And before I jump into the strategies here, just heads up, if you have any questions or anything, I will have question and answer time at the end. So I would ask, because I can't really see if anyone raises their hand or anything. So just hold your questions till the end, and I will answer anything that comes up at that point. So looking at the strategies, I've got 5 strategies today. The first is direct indexing. And this is something that really came about in the last 5 years. It's grown in popularity, and just know that it is only for taxable accounts. So individual accounts, joint accounts, trust accounts, those sort of accounts. If it's a retirement, IRA, 401k, anything like that, it's not going to work. But it is essentially buying an index. It's that simple. Just like you would be buying the S&P 500, if you would buy the NASDAQ 100, if you bought Russell 1000, you can buy those in an ETF. You can go into a direct index and do the exact same thing. The biggest difference is, instead of buying the entire index in one fund, you're actually going to be buying every single holding within that, or almost every single holding. It sounds a little confusing, because you're probably thinking, why would I want to do that? What's the difference? And the difference is you can actually really customize your index. There are a couple places you would do this. A big one is, say you worked at Apple. Apple, based on most indexes, is 4, 5, 6% of the index. And if you're already receiving restricted stock units, or you have stock options, or just the fact that you work there and so you have risk tied to the company, you might be thinking, hey, I want to try to take Apple out of that index, and so I can own everything else, but not that one company. If you're buying the S&P used by SPY or any other index fund, you can't do that. You're still going to have exposure to Apple. But in direct indexing, you can do that. You can customize and say, okay, I want the entire index without Apple. Or maybe you say, I don't want any technology at all. So I want the entire index without technology funds. Or maybe you don't like ExxonMobil and you want to sit something like that out. Or maybe you don't like Tesla. Whatever that looks like. It's not a way for active stock picking, so please don't think that. You're still indexing, you're still buying the entire index, but it gives you flexibility. You can even play in, if you want to overweight towards growth stocks, if you want to overweight towards value stocks, momentum, you have a lot of options there. Not only that, the other benefit and the biggest benefit to direct indexing is tax loss harvesting. So tax loss harvesting is pretty simple. It's selling your losers, taking those losses, and using them to offset gains elsewhere. That's all it comes down to. So if you have $1,000 worth of stocks, some have dropped to $950, and you have some that have gone up to $1050. You sell them all, and you're going to net zero. Or you can actually book those losses and then use them at the end of the year to offset gains if you're rebalancing your portfolio, anything like that. This is a great option. I've used this for a client that had pretty sizable holdings in a couple of mutual funds that had gone up substantially. And we looked at it, we wanted to diversify the mutual funds, but we didn't want him to take a tax hit on it, or not a large hit. So what we did was we put some of his taxable accounts into a direct index. We capture the losses, and typically you'll find losses are 2 to 3% of the invested amount per year. But the good thing is it's 2 to 3% of the invested amount per year, but your returns still look very similar to buying the S&P index or whichever index you're actually following. So we did that. We took some of those losses. We were able to sell some of those mutual funds that were expensive. They didn't have some of the diversification we wanted, and they just didn't really fit into his portfolio anymore. And we were able to get that money diversified and reinvested. So for tax loss harvesting, just in short, if it's a taxable account and if you are looking to diversify, it's a great option. And expense-wise, it's not that expensive. It's pretty comparable to an actively managed mutual fund. Usually 0.5% per year, somewhere in that range. But typically the tax benefits are going to offset the increased cost. Next up is the Roth conversions. And a Roth conversion, I mentioned this earlier, it's just taking traditional IRA money, can be 401k money, which is pre-tax. You're going to pay the taxes on it, move it into your Roth account. That's all it comes down to. And again, the reason for this is you're shifting the timing. So you're going from high income in your working years, and I'm going to tell you, I borrowed this. I thought this was a great slide, so appreciate it from Next Gen Wealth. You're going to go from 32% in your working years to maybe you're in a 22, 24, 32% bracket once your Social Security kicks in and once your RMDs kick in. And that's where it takes a little bit of planning, but you'll see there's a hole there in between where I usually see it from 60 till 67, 60 to 73, somewhere in that range, where you're going to be in a really low tax bracket. And that's kind of the sweet spot where during those years, you want to go ahead and fill up your lower brackets. And I'll talk in just a second about how to know, the amounts to actually convert. But that's the sweet spot typically, first early years in retirement. On the timing of it, you can do it at the beginning of the year. There's some great mathematical reasons why, because that gives you the entire year for that money to grow. The downside to that is, one, you don't necessarily know what your income is going to be for the year. So it's a little harder to guesstimate how much you should be converting. The other thing is, if the market goes down throughout the year, you might find that you converted 50,000 at the end of the year, that's worth 40,000, which isn't a huge deal. But when you're looking at the amount of taxes you paid, the taxes are still going to be paid on that 50,000. And so that actually increases the effective rate, basically the average rate on that. So you can reconvert back to traditional and then do it again the next year. But it just, again, so logistically, couple extra steps. What I prefer to do is converting at the end of the year. By mid-December, usually, you know what your income was for the year. You might have mutual funds that haven't paid capital gains yet, but generally you can get a you can get the idea of what an estimate of what that capital gain will be. And then from there, you kind of know, okay, this is my tax bracket. This is how much I want to convert, or this is how much I can have an income in that. And this is how much income I have. So that gives you whatever the gap is in between, and that's how much you can convert. Just know this has to be completed by December 31st. So if you're working with an advisor, I would recommend they need to get it in generally by the second, maybe the third week, but before Christmas, typically. I've seen too many people trying to scramble to get something done, you know, December 28th and that week between Christmas and New Year's. And sometimes it goes through, sometimes it doesn't. But if it gets kicked through and doesn't actually be complete, it's not completed until January 1st or the 2nd, then it's not going to be, it's going to be in the following tax year. And you don't really want that. So get it done a little earlier rather than later. And then how much? Again, different schools of thought on this. The traditional thought is you want to fill up your 10% and 12% tax brackets totally. And I agree with that. Where I am a little bit different than most, I have a little bit of a contrarian view, is typically on the math side, it makes sense to fill up your 22% and 24% buckets as well. It's going to be different for everyone, so this isn't individualized advice, but for most people, if you push that money, if you push those conversions earlier and still pay the 22% and 24% brackets, most people can convert the majority of their traditional IRA pre-tax money to Roth and then have the rest of their retirement to let that money grow. And if we're looking at the tax brackets, you know, the 24% tax bracket goes up to $384,000. So we're talking a significant amount there. And this is one of the places where I will get pushback from CPAs. And it's because often CPAs, tax preparers, they're focusing on 1 year of taxes, not a lifetime. When you're looking at tax planning, it's not a year by year question. You need to have a long-term plan. And so there will be some years where, yes, if you're going to be doing conversions, especially if you're doing a larger conversion, you'll pay more taxes in that year. And that's okay because you know you're keeping it in a lower bracket, and you know long-term it's going to be better for you. But sometimes that's a little bit hard to kind of get across to folks who are just looking at the 1 year number. The other point to think about here is looking at the brackets, you know, 10% on the low end, 37% on the high end. We were at all-time lows for tax rates. I mean, go back to 1913 when we initially got an income tax. It is in the 70s, you know, we had marginal rates in the 70% range, even 90% range. And no, I don't think we're going to get back there. I know there are folks who are looking to balance our budget by increasing income taxes. I'll just say that. So this is another way that if you think, okay, right now, the middle of the range is 24%, but maybe in a couple of years that's 32, maybe it goes up to 38%. I'm just throwing out numbers here, but it's a hedge by prepaying those taxes, and even if rates do go up, you've already paid. So you're going to be grandfathered, you're good to go. So that's something I'm looking at. And again, we don't know the future. I don't have a crystal ball, but I do know that I don't expect tax rates to go down from here. It's just too hard to make the math work as a nation. And so if you have the chance to lock in a lower rate, I would do it when you can. And then for specifics on how much to convert, this is a pretty simple Excel calculator that I made. It doesn't have all the bells and whistles, but I'll kind of walk you through it. And basically all it does is it takes your tax filing status, your age, how much money you made, and then what tax bracket you want to fill. You put in those numbers, and then it tells you how much you can convert and still stay within that tax bracket. If you want a copy of this, just shoot me a message or reply in the comments here. I'll email it out afterwards. My third strategy is qualified charitable distributions. A lot of you have probably heard me talk about these before. I'm going to say QCD because the entire phrase is way too long, and I know I'll get tongue-tied. QCDs are a really simple option. All you're really doing is writing a check from your IRA directly to a charity. If you look at the graph, IRA, gift, charity, you'll notice that there is one group that is not mentioned there, and that's the IRS. And that's the beauty of a QCD, is that QCDs aren't going to show up on your taxes. So, and they count towards your RMD. So say you're 75, you have a $100,000 RMD due for the year. And you're already giving, call it 20,000 per year in charitable donations. You can make those donations directly from your IRA. They're going to go directly to the charity, and that's going to count towards 20% of your RMD. You're not going to see that, and you're only going to be paying taxes on that remainder 80%. And here's how that typically looks. On the left, traditional withdrawal, people take money out of their IRA, they donate to charity, then they go ahead and offset and try to itemize that deduction on their income taxes. Like I mentioned, though, that doesn't work for most people because most people can't itemize. So instead, if you're using a QCD, you send that amount directly to charity, and you can still take the standard deduction. And so you're not losing the ability to itemize. You're still getting the benefit of the higher standard deduction, and you're giving to charity. So you're giving them the same amount to charity. You are going to be paying less in taxes, and the only group that comes out behind in this is the IRS. In my mind, that's a win. Who can use QCDs? There are three things you need to answer. The first is, are you at least 70 and a half years old? If you're not that old, sorry, you're not there yet. Next is, are you still working, and is an employer still making contributions into your account? If you're still working and still getting employer contributions, no, you're not quite there yet, but once you stop working, you can. And the third, the charity typically has to be a 501c3 or a church. It can be there's some different rules around that, but you can't go to a private foundation or specifically a donor advised fund. I'm going to talk more about donor advised funds here in a minute, but I wish you could give QCDs to a donor advised fund. That would be awesome, but it's not available to us right now. But if you meet those three requirements, you're good to go. You can make a QCD. On how to do it, they're super simple. You call your advisor, you go to fidelity.com, you go to Schwab, wherever your money is. You designate that you want it to go to a third party. You put their information in, and you just send the money. Make sure you set your withholdings to 0 on that. That's one thing I've seen before, that folks are sending QCDs, they still have withholdings set, and since it's not taxable, you don't need withholdings. And then the other thing there is, you also want to make sure there's an ability to put information in the memo line on the check. You want to make sure that it says who it's from when it goes to that organization, because that's another issue that I've ran into is folks have made QCDs, but the organization gets a check from Charles Schwab, and they don't know who to send the receipt to. So you either need to put it on the memo line or reach out to the organization and make sure that they're going to give you a receipt so that you can track that for tax purposes. Again, you're not itemizing it, but you still need that receipt. So here's a quick case study just on the differences between using a QCD and not. By using a QCD, you're going to be paying about $5,000 in taxes. Without, you're going to be more at this $17,500 level. So using a QCD is going to save you $12,000. Again, charity is getting the same amount. You're getting the same amount of income. The only group that is losing out here is the IRS. That's a win. Next up is the 0% capital gains rate. And I kind of talked about this earlier, but this is kind of important for when it makes sense. It really makes sense, and it can be really valuable. So when you're looking at income tax rates, the brackets. So on the individual side, up to 40,000, just or 39,000, has a 0% rate. And on the married filing jointly, up to $78,750 is taxed at 0%. So just for instance, if you have zero income and you sell as much as you want, as long that first $78,750 of gains, not of the total amount you sell, but just of the gains, will be taxed at 0%. Where this is really handy, I've worked with several clients from UPS, for instance, who they worked at a company for their entire career. They received stock in that company, and they had very, very low basis. So maybe they're sitting there, they paid $10 per share, and just again, random numbers. They paid $10 per share, now it's worth 100. And they're looking at it and saying, hey, this stock is 25% of my portfolio, but the taxes are so high that I can't afford to diversify. I can't afford to do anything here. What we've done is we will look and say, okay, how much of that can we sell per year and keep you within that 0% capital gains rate, so that they're able to diversify out of that stock and then, reinvest elsewhere, or even just use it to live on, and use that 0% capital gains rate as a way to really make that happen and make that work. When we're looking at taxes and how this actually works, when you're filling out your 1040, it really starts, if you start at the ordinary income on the left, right? The first dollars that you're taxed on is going to be ordinary income. At the top, it starts asking for wages, then it goes to taxes, distributions, all that. So ordinary income goes in first. That's the first building block. After that, long-term capital gains gets stacked on top of that, and that gets you to your adjusted gross income. So in this case, you'll see 18,150, 11,550, and then that third bracket is that 44,100. That's what is in that 0% long-term capital gains rate bracket. That's the awesome thing. Even if you go above it by a bit, in this case, they had 5,900 that was in the 15% capital gains bracket. They're paying, 15% on that. It's not going to affect all the other dollars. So this is how the math works on them and how I do it for my clients. So we're looking first, what's that income? What's that guaranteed income they have coming in? And then how much can we fill to hit the top of that bracket? That's all it comes down to. So why should you use a 0% gains rate? I mentioned diversification a minute ago. That's, for me, that's the reason I see the most often. The next reason is you can increase your basis. And so again, say someone owned NVIDIA stock. NVIDIA's done pretty okay over the last 2 or 3 years. Say they bought it at $10, now it's at $500 a share. So they've got $490 in capital gains. If they had whatever amount, they could sell their entire position and still stay within that 0% capital gains bracket. They could do that, and then the very next day, buy NVIDIA back, and that's completely okay. You would do this because when you sell and then you rebuy, that gives you a new basis in that stock. So their old basis was the $10. When they rebuy, their new basis is going to be $500. And that resetting the basis, increasing the basis there, means that whenever they sell and they actually want to get rid of it, their gains are going to be based on that number. So that really gives them a lot more flexibility, and it's a hedge against future taxes. And then I mentioned, exiting an expensive fund. This is another thing that I've done several times with clients. Kind of already explained that part. And then I think this is number 5, and this is actually kind of 2 strategies in one, but they're pretty good. And I like using these, and that's gift bunching using a donor advised fund. So first up, what is a donor advised fund? I mentioned it earlier. The easiest explanation is that it's a charitable bank account. You make a donation. Legally, the donor advised fund is a nonprofit. It's a 501c3. You can go through Schwab, Fidelity, Vanguard. I think Vanguard has one. You can go through your local community foundation, Community Foundation of Louisville, Southern Indiana, Bluegrass Community Foundation. They all have these options. When you make that gift, you're giving the money to the donor advised fund, and then you're going to get the deduction right then. From there, it's going to that whatever you give into donate to it. I'll come back to this in a second. Whatever you donate can then be distributed to charity when you want. And this is the cool thing that that money can sit in the donor advised fund for a year, 5 years, 10 years, and it can be invested in there. So it can continue to grow. And why you would do this is gift bunching. Gift bunching is taking 3 years, 5 years, however long, however many years worth of donations that you want to give, making it all in one donation. You would do this because, again, if you can't itemize your gifts all across the board, you're basically front loading your gifts so you can get across that standard deduction threshold, get to the point where it makes sense to itemize, but then you still can actually make those donations from the DAF to your charity, just like they were already getting. You can still split that up in the exact same amount year by year. The only difference is instead of seeing that whatever the dollar number is in your investment accounts, you're going to see it in the donor advised fund. Now, it is an irrevocable gift. You can't get that money back, but you can designate where you want it to go. And another cool thing about DAFs is they're really, really super flexible. So for instance, if you had antiques, that are collectible, if you have a collectible, maybe you have a 66 Shelby GT Mustang. I don't know if they may have GTs, but Shelby Mustang. You could, with the right organization that's willing to work with you on that, you could actually donate the car to the donor advised fund, just like you've heard the NPR commercials on, donate your car. You could give that to your donor advised fund. You wouldn't have to sell it. You wouldn't have to realize gains. They're going to sell that within the donor advised fund, and then the funds will be in there. So you would get the deduction. You can use land. You can use closely held business interests. You have an S Corp, C Corp. There are a whole lot of flexible options. It's all about finding a group that'll work with you on that. Or art. Art's another one that I see sometimes. So it's a really, really good option. Or even just stocks. I mean, this is another option where if you have, again, UPS stock, NVIDIA, I've seen Bitcoin before, where it has grown substantially. You don't want to sell it because you don't want to realize that taxable gain. You can make the donation. You get to deduct the full fair market value of whatever you donate. And so you never have to realize that gain. You're not going to see that on your taxes, but you get the deduction for the full fair market value. So that's kind of cool. Here's how it actually looks on the deduction side. On the left is what deductions would look like if you were giving $9,000 a year. You had $10,000 in state and local taxes and $8,000 in mortgage interest. The takeaway here is you're still below the standard deduction. So even though you're giving $9,000 per year, it still doesn't make sense to itemize. You're essentially not getting anything out of that gift. And I know we don't give because we want money back. Giving to charity should not be about the tax benefits. That's not it. You give because you want to make a difference in the world. You have an organization who you want to support, who's doing work that you want to further that work. But if you're giving, you still should try to get the benefit of it. On the right is the actual strategy and how it looks in practice. So you're making a much larger gift in the first year, and then every 3 years thereafter, so in the fourth year as well. The benefit here is in the first year and the fourth year, you can see you're actually getting enough donations that you're able to itemize those deductions. And in those years, you're getting an additional $17,300 in deductions. So that's an additional, $4,000, a little bit more than $4,000. That's going to reduce off of your taxes if you're in a mid 20% effective tax rate. So that's a pretty big deal. And it's not that hard. I mean, setting up a donor advised fund can be done in an hour, less than an hour. Actually making the donation, it's very simple. Most donor advised funds just have an online portal that you can set up if you want those contributions to go to your favorite charity monthly, quarterly, on an annual basis. It doesn't matter. It's very easy. I mentioned if you're giving appreciated stock, and here's a breakdown of the numbers on that. You know, if you're giving a $10,000 gift in cash, if you sell a stock and then gift the cash, you're going to save about $3,700 in taxes. On the other hand, if you actually get the stock and you don't sell it first, the deduction is going to be about $5,300, almost $5,400. So we're talking $1,600, $1,700 in difference there for the exact same gift. Again, it's not hard. I've transferred stock for gifts. I don't know how many times. Very, very easy. Now, we've talked about 5 different strategies. Now, let's talk about how to actually put those into a comprehensive plan. Because if you're just shotgunning and taking one strategy and trying it here, it might have impacts other places that you don't really know about. And I'll be really frank and say tax planning software is the best way to do this. I use Right Capital. List of Plan's a good one that I like a lot. You can even use Excel, but you really have to have a baseline and be able to see year to year, how is this going to affect things? But really, you start out by defining your spending needs and saying, okay, I need $4,000 a month. I need $6,000, $10,000, $20,000, whatever that number is. Then you look and say, what's my guaranteed income? Social Security, pensions, disability, anything like that. Whatever the difference is, that's going to come from your retirement savings. And that's how you know, that's where you begin the process of figuring out which account am I going to be pulling that money out of. If you're looking at a tax efficient withdrawal strategy, 9 times out of 10, you're going to start out by looking at your taxable accounts. Living trusts, joint accounts, individual, that area. Because you're paying capital gains rates, you're going to be able to pull money out of there at a lower tax rate than you would by looking at your pre-tax accounts, which come next. That's going to be your traditional IRA and your 401k accounts. Could also be SEPs, simples, profit sharing, all those. And then finally, you got your Roth IRA, which is your post-tax or tax-free accounts. And typically you want to wait as long as you can before you start accessing that money because it's growing tax-free, and that's pretty awesome. So taxable, pre-tax, post-tax. And here's how that kind of looks. One of the biggest differences between retirement and work is when you're working, you know, you're going to get paid twice a month. Maybe you get paid bi-weekly, but you get one check and you know what it's going to be for. In retirement, it's a little bit different because you're typically going to have a replacement by kind of a coalition of sorts or committee that you're going to have a social security check that comes in once a month. You're going to have a pension, maybe you'll have annuity payments, and then you'll have your IRA distributions. You'll end up with 4 or 5, maybe even 6 transfers per month that in total match what you need, what your planned income is. And that's all that this is showing, that starting out at 65, this person's taking out money from their taxable account and a little bit from their traditional IRA. Once they hit 72, that's when they're switching to RMDs because they have to take their RMD. And again, 72, it's actually ends up being 75 here in a bit, but so 72, 73, we're right in that range. And then they're taking out more money again from their traditional IRA. And then once they hit 83, that's when they start taking Roth distributions. Just know that your Roth money can also be a good place that if you need to take out a couple thousand here, a couple thousand there, maybe you want to take a trip, maybe you want to do something special, whatever that is, but you don't want to take a tax hit on that. That is a great place to be able to pull money out, especially if you're looking and you're getting close to IRMA, which is the income-based addition for Medicare. Now IRMA kicks in around, I think it's 160,000 for a married couple. And just typically Medicare is, the cost is based on your income. If you're under that, it's going to be $174 a month, somewhere in that range. But that can almost triple if your income is high enough. And so when you're looking at these, and when you're looking at conversions on Roths and all these things, you need to make sure that if you're close to that IRMA guideline, that just stay on the low side of it because there's no reason to bump up because that just increases your effective tax rates on that. There are 2 ways, I mean, there are multiple ways, but 2 specific strategies that I like to combine. The first is Roth conversions and gift bunching. This one's pretty straightforward. So like we looked at a minute ago with gift bunching, on the years that you're gift bunching, you're going to have more deductions. What you can do is you can pair those increased deductions with an equivalent amount of Roth conversions. That's going to be giving you the exact same amount of taxes that you would have paid had you taken the standard deduction, but you're going to end up with more money in your Roth. It's that simple. The other option is qualified charitable distributions and the long-term capital gains, 0% long-term capital gains. When I say pair these, especially from 70.5 to 73, 75, when your R&Ds kick in, you have a little bit of a window there where you can go ahead and give a QCD and then take some of that money out. Your income is still low enough because it didn't affect your income that you can still realize 0% long-term capital gains. So you can do that, and you can still continue doing this after you hit R&D age. That's even perfectly fine. But the QCD really shines because it doesn't affect your taxable income. So it's not gonna keep you from the 0% long-term capital gains rate. And then just kind of summing it all up, the way I look at it, and I said this earlier, you can't invest without thinking about taxes. Everything we do in financial planning has tax ramifications. And if you want to get the most from your financial plan, from your retirement plan, you need to be talking about these. So your advisor, if you already have one, they should be talking about their tax plan, about your tax plan, and how to maximize your after-tax wealth, not just returns every year, because it all goes together. You should be having annual tax projections. My clients have, or at least I have in their planning software, tax projections out until age 90 or 95, depending on the client. And we can see from year to year, how is this change that we make now going to affect things on down the line? And then also, your advisor should be reviewing your tax return pretty much every year. And this goes even for new clients that if you're working with someone, they should be asking for your tax return. I do it for new clients because I want to see what did they do last year, and is there any opportunity for improvement going forward? So honestly, if they're not asking for that, I would ask why. And now it is question and answer time. So I'm going to go ahead and open this up. If there are any questions and answers, I want to stop sharing for a second. And my video is started. So you can drop questions in the chat and I can see it over here. Or if you want to send a direct message, you can also do that. And then last but not least, my only ask here, it's not a sales point, but if you want a second opinion, I'm going to offer a review, tax strategy review for anyone that's on this call. It's really going to tell you one of two things. First, and I've told this to plenty of people, and that's just that, hey, you're doing all the right things. You're optimized, your portfolio looks good, your taxes are in a good place. There's not a lot of changes to make, and that's good news. And it's good to have that second opinion to say, yeah, I don't need to worry. The other option is if there are places that can be improved, then I'll give you a list of personalized suggestions and strategies that you can use that you can take and implement them yourself, take them back to your advisor, or I'm always happy to help. So if you're interested in this, I'm going to put a poll at the bottom, and no one else can see this, so you don't have to worry about your answers being seen here. And this is just going to be for me so that I can see if you're interested. If you say yes, then I'll just reach out afterwards and we can get something scheduled. Otherwise, that's all I have for today. I really appreciate your all's time. Thank you for coming out. Like I said, I always love talking taxes, but not everyone enjoys this. So thank you for your time. And with that, I'll go ahead and let you all get back to your day. Have a great weekend.